Yeah.
Shall I kick off?
Yes, please kick off, Julian.
Okay, good day to everybody, and thank you for attending this webinar from Nanhua Futures, entitled "A New Era of Global Commodity Trading: The Opening of the Chinese Derivatives Market." My name is Julian Dixon. I'm a Senior Business Development Manager from CQG. I will be moderating the session. Just a little bit of housekeeping to start. Can I ask that if you do have any questions, that you pop those into the chat, and then we can revisit those after everyone has spoken, for kind of like a little bit of a Q&A. So it just gives me pleasure to introduce our first speaker, who will be giving us an overview of the INE bonded copper market, Mr. Lichen Zhu, who is a Senior Manager of the Commodity Futures Department at the Shanghai Futures Exchange and the Shanghai International Energy Exchange. Mr. Lichen Zhu, it's over to you.
Okay, thank you, Julian. Can you see my screen now?
Yes, we can. Yep.
Okay. Hello, everyone, and thanks for Nanhua Futures inviting. And on behalf of INE, it's my pleasure to give you introduction and outlook of the INE bonded copper, so which known as BC copper. So before moving to my slides, here are some overview of copper and the copper futures contract. As the most consumed non-ferrous metal in national economy, copper is industrial and financial nature and known as doctor. And China is world's largest producer, consumer, and importer of refined copper. So the launching of BC copper definitely marks the milestone of futures opening up of China's non-ferrous futures market. So here's the disclaimer. And in the next 20 minutes, I will start with the history or background of the opening up of INE first, then history of the China's copper markets, and then present the general overview about BC copper and a bit comparison with the SHFE's CU contract. And in the last part, the recent market performance and the future plans on BC copper will be mentioned over 2 years. Okay, so let's start with the SHFE and INE copper market. So this is opening up the milestone of SHFE and INE. So in the early of the 2013, we established the brand new international platform, the International Energy Exchange. So we as known as INE. Then we have our very first international futures product, crude oil, on March of 2018. And 2.5 years later, we launched bonded copper futures. The most exciting news about opening up is like all the rest of the other Chinese futures exchange. SHFE and INE released circulars that confirmed the scope of the products accessible to QFII. And both SHFE copper and bonded copper are on the list. So that means that since the September of 2022, there are 2 different channels suitable for the foreign investors. So on this QFII, and the other one is for the specific products. Now in INE, there are 5 specific products in total, and BC is one of them. So after decades development, we've already had our over 115 domestic futures firm members, 79 overseas intermediaries, and 3 overseas intermediaries. Now let's focus on copper itself. CU Futures is the first product listed on SHFE. Actually, it launched even earlier than the established of SHFE. And now this year, 2023, is our 30th anniversary of the launchment of copper futures. It also became one of the earliest commodity futures in China. On May 28th of 2018, JunHe launched the standard warrant trading platform, and the corpus warrants become available for trading, which successfully linked for the futures to physical side. On the September 21st of the same year, we listed the copper options, became the first option of industrial and the non-ferrous product. The last significant milestone of copper market would be the day of November 19th, 2020. JunHe's only wholly owned subsidiary INE listed the BC Futures. So bonded copper futures and JunHe copper futures made up the dual contract mode, and the copper option, along with the standard warrant futures, diversify China's copper derivatives market. Thanks to such diversity, China's copper industry now numbered among the most market-oriented ones, is able to adapt to change in the international market promptly and cope with the market shocks properly. So to be more specific, BC Futures in China's is China's first non-ferrous metal product accessible to overseas investors. And it's also China's first futures product that adopts a dual contract mode. Along with CU Futures, let's compare with the two different contracts. After nearly 30 years operation, it has become one of the most mature products in China's domestic futures market. It serves the domestic market, and the price reflects the domestic supply and demand. Now, CU price has become the pricing benchmark for domestic copper trades. JunHe, together with LME and COMEX, is among the world's 3 major pricing centers of copper. So when it comes to BC Futures, it is designed for both domestic bonded market and international markets. Its price reflects the offshore supply and demand. Apparently, BC Futures aligns with the INE's unique features of international platform, net pricing, bonded delivery, and RMB denomination. And it's subject to specifications and the rules of INE. As we all know now, in September, we have announced that QFI can trade futures and options products listed on JunHe. So which means is a further opening up to both CU and BC Futures. So let's move on the second part, BC Future overview. So this table shows the major parameters and information of BC Futures. For example, the product is the copper cathode. The contract size is 5 metric tons per lot, and the price quotation is yuan in RMB per metric ton, and it's exclusive of tax and custom duty. The minimum price fluctuation is 10 yuan per metric ton, and etc. Like all the other futures of JunHe and INE, they have the same listed contract, trading hours, last trading day, and minimum trading margin. So BC contract appendix mainly includes the delivery-related specifications. And like the delivery unit is 25 metric tons per warrant, it also details the quality specification. For example, the tolerance on each warrant is plus or minus 2%, pound difference is within, and the pound difference is within plus or minus 0.1%. For the copper underlying each warrant must be of the same manufacturer, grade, registered trademark, quality grade, shape, and secured into bundles of similar weight. Besides, the deliverable and registerable copper cathode for BC Futures must be of a brand registered with INE or a JunHe registered brand recognized by INE. Up to the end of 2022, there were 51 BC deliverable brands from 40 different manufacturers in total. So there were 22 overseas companies contributed 21 brands to participate, and you can find the most updated full name list and the information via the link. All the existing designated delivery warehouses for BC Futures are located in Shanghai bonded area. with a total capacity of 225 kilometric tons. You can also find detailed information of all the warehouses via INE's official website. So I'd like to keep this part short, and let's compare the two copper products to the end of this part. So basically, they are different in product symbol, listing platform, price quotation, delivery mode, delivery period, and etc. But they are exactly the same in contract size, price quotation, minimum price fluctuation, and so on. So besides, they are also different in position limit, threshold for large trader reporting, deliverable brands, and designated delivery storage facilities. Trader eligibility requirements are not applicable for to CU futures, but to BC futures. So the transaction fee for CU futures is higher than new BC futures. So also, the market maker was introduced to BC futures in order to bring more market liquidity at the very beginning. Now, BC futures have been ran successfully more than 2 years. And at this time point, I would like to share how bonded copper futures developed during the period. During the past 2 years, the new generation product gained wider popularity with both domestic and overseas investors. They included it in the hedging toolkit and adopted its price as a benchmark for international spot trades, effectively boosting the ability of bonded copper futures to serve the real economy. On this chart, it shows the trading summary of BC futures. As of May 13th, 2023, the BC market have 202 million lots in trading volume and achieved 4.7 thousand metric tons in month-end open interest, indicating the trend of the steady increase. So let's move on to the price movement of the BC copper. So when we put the last 2 years futures, BC futures spot price and LME copper price together, we can easily find a high correlation between those prices, no matter whether the price at low or high point. So in the more than 2 years after listing BC futures, the coefficient between the BC futures and the LME future price was 0.95, and that between BC futures and the spot prices exists 0.99. So also, the physical delivery has long been an important function and been of futures product to regulate the resources allocation. Now, BC's deliverable resources of the bonded copper futures are expanding, providing greater convenience and more choice to clients who require actual delivery. So right now in the bonded area, agencies have spontaneously generated bonded copper's spot price in RMB. So totally change the current status of that only use the US dollar denominated copper price existing here. So now both MySteel and SMM, the agency, publish the spot price on daily basis. So after that, on our first anniversary of BC's futures launching, the large copper companies like JunHe Copper, Zijin Mining, IXM, and Lobham from Singapore agreed to use BC futures price as benchmark or reference in their contracts of buying and selling copper concentrates and refined copper. Though the RMB denominated BC price has gradually become an emerging price benchmark in cross-border trades. So in the past 2 years, we also witnessed an optimized investor structure of the bonded copper futures. Especially the corporate entities now rank among the most active clients in bonded copper futures trading. So in May 2022, SHFE and INE, based on the actual operation of bonded copper futures, so piloted a campaign engaging more clients from the copper industry and encourage members to better serve the corporate clients. During the campaign, the open interest and the trading volume of the bonded copper futures increased by 41% and 32% year to year, respectively, a soaring in position held by the clients from the copper industry. And in this year, we are continuing to running this campaign to trying to bring more trading volume and more open interest. So in addition, so the overseas traders have also been permitted to participate in trading, delivery, and the pledge of standard warrant of the bonded copper futures. The last but not least, ultimately, we are looking forward to build a new pattern of global copper market within those 4 markets. And we're also looking forward to bring more uptrade opportunities for all the overseas investor and domestic investors. So along with the current 3 biggest copper futures market around the world, we aim to we could create more arbitrage trade opportunities. So the bonded copper futures can be a real bridge that connects LME copper futures market and the SHFE copper futures market. It can effectively smooth the irrational fluctuations of price differences between the domestic and the foreign copper markets. So in the long run, we will dedicate ourselves to develop the BC futures into a very useful and valuable financial risk management tool to the global investors. On operation side, we are working on applying trading at settlement mechanism to BC contract together with the CU contract. So this mechanism has been successfully applied to INE's crude oil contract to meet certain investors' specific necessity. So marketing is also a consistent approach to get people know more and know better about the BC contract. So we would organize more seminars like this together with the futures company, and both online and offline. We also would like to invite more expertise to share more experience how they use BC contracts to measure their own risks. So last but not least, our designated warehouses will be expanded overseas. So in that case, the location, the feasibility, and the mode of the overseas warehouse establishment will be considered very carefully to make BC contract a more global reached product. So all right. That's all for today. Here are INE website for more details, contract information, and the overseas intermediaries list. So if you have further questions, please feel free to contact my colleague in Singapore or via this contact information. So I hope you find this presentation information. Thank you very much.
Thank you very much, Mr. Li Qianzu. I'm sure many Western exchanges would give their right arm for 40% year-on-year growth in open interest. Okay, so that brings us on to our next speaker. There's a slight change here. Mara Zhang has actually called in sick, so it's now down to Alex Zhang, who is the Senior Manager of the International Department of Nanhua Futures, to take up the baton. Alex, I will pass over to you.
All right, thanks, Julian. So I'm Alex, and thanks for the introduction. So I will be the alternative speaker today for you all, and I want to give a quick thanks for all the attendee and the host, and also Mr. Jolie Chen representing the exchange, and Julian Helme for CQG, and also Austin on the law side. So I think the whole thing we're trying to build here is because we're Nanhua, and we get CQG as a incredible platform provider with professional IT support, and also Shefi and INA is like, I would say it's the closest exchange that we've been working together with in terms of the international business, and also the JunHe LLP. If you have any law side questions, you can ask later on. So I will kickstart for my part. So we've been covering key insights for foreign investor participation in the Chinese derivatives market. Okay, so the first one, we're seeing a little bit of background information. So this is the landscape of China derivatives market. On the top row, we're seeing the volume by region, global derivatives trading volume actually. So as we all know, the whole futures thing representing the derivatives market originally starts in Chicago, US. So we can see at the very beginning the trending on the North American line was on the top, but starting from the 2018 or 2019-ish, the Asia region, especially China, we are growing rapidly in terms of the trading volume because like all the exchanges and also the trading knowledge for every investor here in China are growing more and more with their each expertise. So that's why we are here in China and trying to build a bridge connecting here and there with, as also Mr. Jolie mentioned, so probably with EU region and Asia Pacific area and also North America as well. So on the right bottom, we're seeing the readiness of the firm for Chinese futures market. So this is the data we get from a reliable third party showing that comparing with the year 2020, there are 30%-ish of the potential clients or even existing clients, they are trading Chinese futures market. And now actually to get either more trading volume or they really wanted to get more trading scope, in terms of the trading contract. And the last part, it says at this time Chinese futures market are not relevant to our business, and to that part we are seeing about 10% of the decreasing needs in that one. And this is a comparison chart for three major channels for accessing China derivatives market. So on the right corner, we are seeing the comparison, but we're going from top to bottom one by one. So first one is QFI. So that's where we've been focusing on lately. And it's facing financial institutions and trading firms as our potential clients. For the funding, usually locates offshore, and either it's self-financing or fundraising. It's really up to the clients. And for a bank account, so it's QFI, and the QFI has their own designated custodian bank account. It could be chosen by the client's preference, but we do also have our own recommendation as well on our side as a broker. And margin, we will take RMB as the margin currency, and the treasury bond will take a 20% discount. For tax, the profit portion exempt from value-added taxes, but there is a possibility that it will be subject to a 10% capital gain taxes. And for the second one, we've been working closely with Shefi and INA is the internationalized contracts. Mostly we're dealing with industrial clients and financial institutions and also trading firms as well. And for this one, especially comparing with, so the difference comparing with the QFI one is that it has a dedicated NRA, it's called a non-residence account. If it trade directly with the China broker, so the clients have to open their own NRA account before, it could be parallel running when the clients come to us as a brokerage business. And also offshore bank account, if you trade with qualified overseas intermediaries, And then we will have to mention that one of our Hong Kong subsidiaries is our current overseas intermediaries. It's HGNH International Futures Company. It's located in Hong Kong. It's a licensed and it's fully licensed and a regulated entity. And for margin, we take RMB as a primary currency, and if you use US dollar, there will be a 5% haircut, and it's tax exempted as well. So the third one is what we usually said, WFI or WFI PFM, and the same class, the same type of clients, the same type of the funding, but the bank account usually it's a domestic bank account instead of it's like an offshore or it's a custodian bank account, and the same margin policy as QFI, but it does have 25% of income tax and 6% of value-added taxes. So the comparison generally among these three is that the QFI comes with great fund flexibility with a wide range of investment instrument comparing to internationalized contracts. But when the clients need to only trade in an internationalized contract, the benefit for them is that the fund stays in offshore, but it comes with a limited investment scope compared to the QFI. And in terms of the FM structure, it is a little bit comprehensive, and we will usually provide that with some of the existing clients. We can give them such like a one-stop solution when they come into us, and we can write a whole project for them to to further working together with. And the next one we will give a little bit definitely. So I believe most of the attendee here in this webinar are familiar with what QFI is and what was QFI. So it was QFI and RQFI back then, but since the new regulation, it comes together with a whole name with QFI. So on the right diagram we are seeing right here, QFI investment scope is, so it does have interbank market, usually it's bonds. When the clients ask us if the QFI can investment interbank bonds, no matter it's bond derivatives or bond repurchase, it is a definitely yes. And also for sure, it's a long-term yes for the QFI is that stocks exchanges. So no matter it's shares or IPO or it's security margin trading, these are all included in the QFI investment scope. And the third and fourth one is we've been working on as a futures brokerage here in China is that for futures exchanges, if the clients want to invest in via QFI for stock index futures and options, but these two are for hedging only. These are the CFEX, the China Financial Exchange, Financial Futures Exchange actually, contracts. And also the two on the following one is the commodity futures and options with a selected product we'll be showing on the next slides, and also others. So it's private funds and public funds, and private funds can also be viable with QFI. But for these funds, these have to stay with exactly the same investment scope as QFI. So you are not allowed to to route your trading path through public funds and private funds. So this is the QFI investment scope we'll be talking about in the last slides. So it shows the QFI investment scope and the internationalized contract on the right side. So we are sorting by exchanges, DCE, so Dali and Zhengzhou, Sheffield and INA, and also CFEX. So together on the left bottom, we're seeing if you are investing through QFI, then you are viable for 27 futures contract plus 19 option contract. If you are going in via internationalized contract, then you are tradable for 14 futures and then 9 options contracts. So that's why we said if you are going through QFI, you will get a wide range of investment scope, and that's actually what the clients want mostly. And for exchanges, we are seeing right here. So Sheffield and INE here we put them together, and they do both have copper, but the SHFE copper is the what we call the domestic copper, the domestic Shanghai copper. It does have futures and options together, but it's not viable if you are if you are the internationalized contract trader. And this copper right here under INE is what Ms. Jolie Chen mentioned in his part is the bonded copper one. So you can both trade the bonded copper via QFI or a nationalized contract, but the shortcoming is that it does not have its options yet. But from our past experience dealing with the clients, so probably 3 or 4 years ago, before bonded copper comes live, the most needs we get from clients is actually INA crude oil for sure. So people are using the Shanghai crude oil as their left hand, and the right hand they're probably holding the ICE Brent or the CMA. So they're doing the arbitraging. But now, since the INA bonded copper are getting more and more popular, we are also getting more needs from the EU region, the usual LMA trader that are interested in these kind of arbitraging. And this slide we're showing right here is a bit of a risk management in-depth review here with the exchange rules. So, so basically we have the margin rules. It's a real-time risk rate reminder. We set 80% at the early warning, 100% margin call. If you hit 100% and you did not add funds further, or you didn't liquidate such positions till 2:30 p.m. and we goes into forced liquidation process on a T+1, so which is also the night, which is usually the night session of the same calendar day of the date. And hedging rules, it's applicable for the CFEX trading because the CFEX, the stock index futures and options are for hedging only. And we do also, the exchanges actually, the exchange do also have position limit and trading limit, and also here are some suspicious trading activities. They have their own flag rules if you are, you're not allowed to spoofing or anything like that. So we have a whole manual book showing each exchange have such kind of rules indicates some sort of products. So these are also what we usually get asked when the clients have already on board and they are really curious about how the risk management are provided on our side as the brokerage, and also how it is provided on the exchange level as well. And here on the next slides, we're seeing our IT solutions here for Nanhua. So in the top left corner, we are, it is the trading network resources. So this is a topology of some of the major data center or data hubs here in China hosted by the exchange. And also we are seeing these, we can share this bigger picture later on if anyone's needed. So here on the connection line here, these are the dedicated or the leased line we get from our server room with from the data center to the server room, and we do have each. So we do have plenty of server rooms co-location at the nearest site for each data center. And on the right one for so on the clients. So for general clients, we usually provide with them, the designated trading platform on the client's preference from their past use or what would be their first choice. So we have Bloomberg EMSX or Bloomberg Trading Book. We are dealing with Bloomberg a lot lately. And also CQG, TT, ESUNY, and CTB Fix. And what we have to mention here is that what we mostly get needs from the overseas region when the clients are the the type 1, the general type of clients, we usually get their trading needs on the CQG platform, because most of them are really into the auto spreader, the arbitraging function. The interface is really what they are choosing, is what and why they're choosing CQG over other platforms. It's really convenient and straightforward for them if they're a really arbitraging type of clients. And on the right side, we are connecting for sure each of the exchanges, CFEX, Sheffield INA, and DCE and ZCE. And also for the upcoming Guangzhou, the JunHe is also one of our potential futures exchanges right now. And for co-location type of clients, we have, you can see the server room names correlated with each exchanges. So, but we have to mention here on the top one, the CFEX, the CICC mobile server room. If you are a co-location type of clients, we are moving to our new site because the CICC mobile is really at its full power capacity right now. So we are having another server room. It's around the same physical distance with the CFEX exchange server room. So it has approximately the same latency as the previous one. It's called the CFEX Tangzhen server room. And also on the third column, the trading interface we provide accordingly for these exchanges. For example, for CFEX, we usually provide NHTD, that's our self-studied trading platform with API connected to CTP, and also EDA and the Shanghai REM. These are the three top choice for CFEX. And also for Sheffield and INA traders, we give the CTP subseed and NHTD, EDA, Shanghai REM, and the eSunny as well. So you can see for if you are a Sheffield INA, no matter you are a bonded copper trader or you are a crude oil trader, you have the most you have the most number of choice in terms of the trading interface. And for the market data, we usually provide with NHMD. So NH is Nanhua. So it is also one of our self-studied market data platform we usually provide to the clients. And also, if you are a Sheffield INE trader, the market data, you can also choose Shanghai REM as well. So the next one, we are seeing the data support. So Nanhua Cloud Services. So the database resources we usually provide to the clients is really popular this year, is that we store such things like Shanghai and Shenzhen Stocks Exchange data, bond or public-private fund, or some of the historical exchange market data or API real-time market data. We upload those and store these on the Nanhua Cloud, and we can provide the access to access services of Nanhua Cloud to the designated clients if that's really what the clients need. And on the bottom, it's just a little configuration. It's a configuration says you have to meet these requirements. It's got to be Windows to Linux operating system to dial in the Nanhua Cloud services as well. And next page is the asset management services we provide. We usually do this as our, we can call it the value-added services. So it's, we can match clients and tier one investment advisors. So no matter you're holding funds looking for a top tier investment advisor for trading or vice versa, we can do it for you. And also such things like customizing fund vehicles for clients or accessing to Nanhua wealth management or FOF allocation, overseas structured fund, etc. Because we do have our like the giant group of our subsidiaries in Hong Kong, Cayman Island, we can see in the next couple of slides. So we can fulfill any types of clients' needs basically. So next one we have to mention is that it's also one of our self-studied Nanhua commodity index. So it's a really popular index. We are seeing the growing needs from the EU region recently, actually. So it's a so the Nanhua commodity index was established by Nanhua Research Institute and is compliant since June 1, 2004. So we can see the diagram at the bottom here. So since 2004, it has strong correlation with the CRB commodity index and also Bloomberg and S&P commodity index as well. But it starts drifting apart around I think it's 2015. So the difference in the range of ups and downs is mainly caused by the difference in covered variety and the corresponding weight in each commodity index. So we can see since 2015, our Nanhua commodity index are growing, drifting apart, divisively comparing with the rest of the three. So if you're interested in getting any types of these commodity index data, we are more than happy to assist. And furthermore, it's a little bit more background about Nanhua. So we are a first A-share listed futures company with derivatives business as the core in China here. So we established the company in, so the company actually established in 1996. It's a global service platform for financial derivatives. And we have to mention that we are the Chinese futures company with the largest number of overseas subsidiaries. So we can see the top left map here, probably too small, but our headquarters is here in China, Hangzhou, and we have 40-ish branches across the whole globe, including here domestically in China, and also we have our Hong Kong subsidiaries, and Hong Kong and Singapore are mainly focusing on the Asia Pacific area, and our UK branch here in London, and the US branch in Chicago, and also Cayman Islands as one of our major SPC company, working with our Hong Kong RA9, the asset management company, together providing clients with, together with a QFII or designated accounts. It's also and also the structured products as well. Thank you, and that will be all the content we want to share as Nanhua Futures today. Feel free to contact us, our NH Overseas at nawa.com, or simply follow us on LinkedIn, Twitter, and Facebook, or simply subscribe our YouTube channel. You can search our name. On the right corner should be the presenter of today's Mara One, our Assistant Vice President. And you can follow her on LinkedIn or simply scan the QR code at her WeChat for convenient communication for any future collaboration possible. All right, thank you guys that's all my content for today. Back to Julian.
Thank you very much, Alex. Great job. Okay, so in short order, we'll bring on the next speaker, who is Helmut Müller. Helmut is a senior product specialist at CQG, and he's going to talk about what cross-market arbitrage solutions CQG can provide. So I'm going to pass things over to Helmut.
Yeah, thank you very much, Julian, for having me here. I'm going to share my screen with you. That hopefully works immediately, and you should see a CQG screen. We'll start with a little PowerPoint presentation first, but I promise that I will only go over very few slides to introduce CQG and myself. CQG is in the market for 40+ years, serving our clients in technical analysis, direct market access, and in constantly changing environment. We're always on the front edge to figure out what the clients need, what they want to do, and we are providing the solutions for that. Yeah, my name, Julie mentioned, is Helmut Müller. I'm working out of CQG in Frankfurt since 26 years now as an application specialist. My main expertise usually are in the direction of programming things inside CQG, using our high-end platform, CQG spreader network, and educating our internal CQG personnel as well as our clients and future clients. We do have offices around the world, so we do have a support office also in Shanghai. We are in Australia, in Singapore, in Europe, of course, and in the United States. So our customer support will like follow the sun on a 24-hour 24-hour base. So anytime you have something, you can always pick up the phone and give us a quick call. So CKG network, just a very basic slide in the beginning. So the idea on the CKG infrastructure is it is like a one-stop shopping network. The big piece here in the middle is the CKG environment where we have all our data servers. We have all our hosted services, trade routing gateways, messengers, parcels. Everything is like controlled by CKG itself, by us. It's shown as one bubble, but of course it has co-location for security reasons, so that if one data center might go down for whatever reason, we can easily switch between locations in different continents. Our customers usually connect via integrated client, QTrader, desktop, mobile, or APIs, normally via the internet to our CKG data center in the middle. And sometimes there's very little leftover number of users. They're using leased lines for security reasons, but these days, like everything is going to the internet. And on the output, our network connects to, meanwhile, more than 70 plus FCMs. They use our infrastructure, they use our cast environment, they use middle office, back office, and trading solutions from us. And we connect to about 60 plus exchanges around the world. First of all, like in the beginning, just for market data, and for the last 20 plus years also for direct market access as well. I would like to have a little closer look on the infrastructure here to understand what's the benefit of using CKG in that respect, because I changed to that slide here because I can paint around here a little bit. So the big benefit on the infrastructure here is, so you're a CKG trader connecting to our network. You want to do, it's especially important on arbitrage and spreader trades. You want to do a trade, it goes from your PC, it goes to the CKG exchange gateway, it will be checked on the risk engine if everything is okay. You can trade that, there's enough margin on the account, and so on. So first, then the trade would go to our server at the exchange, and you would be filled. And if markets match, you get a fill report, and it goes all the way back. So this is like the normal way of connecting things. In the CKG spreader environment, on most exchanges, on the most important ones, and on demand, if we have large customer demand, we have servers very close to the exchanges. So what happens, you put your spreader order in like before, it goes to the risk engine, it checks whether you're allowed to do the spread, if you have enough margin, and all of these informations. It goes to the risk engine. So far, it's exactly the same principle, but now all the cancel and replaces are only happening between our proximity gateways and the exchange. You get that information on the back channel that, of course, you're filled or where your orders are, but the speed between the proximity gateways and the exchanges are very, very important to get you good fills and to get you really, really good places in the queue. If you have travel around the world, depending on your location all the time, just physically that adds milliseconds to it, which we trying to avoid here with that technology. Let's talk a little bit about copper INE trading. I really like the slides from the speakers before very much. I put a very, very basic focus on the market itself, because I was sure that there's some light scat on the details. On CKG, we are connecting to INE, of course, the copper trading in RMB per ton, and with the CKG platform with very, very, very easy conversion rates. You can manipulate the data. You can change the data. You can do any kinds of calculations. So when I was investigating, like, what can I do here on the arbitrage market, the first step I was trying to convert the RMB per ton into US dollars, looking from this side, from the European side. So I converted the market into RMB per ton. And I'm just using a fixed conversion rate here. You could also use RMB future to have that as an ongoing process, but it makes life just simpler if you look once on the chart and you put the conversion rate in, and then you're all set. I looked into the possibility to trade London copper on the LME versus INE copper. So therefore, London is also listed in USD per ton. So that is really, really convenient. So I can use the copper contract directly, was like 8,300. The screenshot was taken a couple of days before. And the converted bonded copper into US dollar, and you can immediately see that there is some kind of price correlation. Once you have that artificial contract, I would call it, once you have that formula established, which is only really a couple of mouse clicks, you can put that data into any kind of chart in CQG for technical analysis. You can put all kinds of studies and indicators and mathematics around it. So once it's in there as the normal copper contract, and on the other side the artificial contract I created in US dollar, once it's on the chart, it's totally flexible to use. And I took the chance to overlay the two charts and to see if there's any correlation expected here. And obviously it looks like there is. We do also have more sophisticated studies where on a real-time basis, really can, with also like a simple piece of formula, just type correl for correlation, give me the BCUS 1 ton, which is my artificial contract I created, versus the London copper over 10 periods, and give me the correlation out of that. Within a fraction of the second, the CQG software would spit out this correlation information immediately on the chart. So it's very, very easy to use. Once you got into CQG in the formula business, you get the training from our side, but it's very easy to use. So once we have the two markets and we see the correlation into it, of course, why not just building the spread out of these twos? They're both now converted into price per ton in US dollars. So you can do the one contract minus the other contract. Just keep in mind the conversion rate. I just adjusted, it says 0.14, adjusted that slightly this morning, and you get a real-time chart of that spread. And of course, once you have the real-time data on the spread, we are able to put that artificial spread contract we just created also on a ladder. And this is the the moment when I want to change from PowerPoint slides, which are not moving, into some real-time data on the platform. Unfortunately, when we decided when we want to do this presentation during this time of the day, the bonded copper future at the moment is not trading, so we are past the last trading hour, unfortunately. So I can't do the arbitrage on a live environment now against the INE future, but I can do on a real time or live base, just as a demonstration purpose. It works exactly the same way. I was playing around with that. I can show the US copper versus London, which is basically this spread here. So I have a quote spreadsheet here on top where I have all the markets that are interesting for me. So I have the BC contract. If I just want to outright trade the future, of course I can do that. The little check mark tells me that it's not trading at the moment. Otherwise, I would see here the current market depths and bids and asks. This is the artificial contract I created. I just used a bonded copper contract and calculated the RMB into US dollar. And the first step I did, I was comparing it against copper in the US. And the US copper is traded in LBS, in dollars and cents per LBS. It's 25,000 LBS, and that's about 11 tons. So I thought, like, okay, why not just converting the bonded copper into an 11-ton contract? So I just put the multiplier in again, and I could compare the two directly again. So it's the whole like contract strength would be $95,000, and compare that with the CPE and converted the price per LBS into tons. So you could technically build a spread this way around if you want to. Of course, I can trade the outright copper, which is now up and running and open. You see the market depths here on my ladder. I can easily trade outright contracts here on the exchange. It's pretty early in the US, but the market is online. So here's now the spreads I created. I created US copper against the bonded copper. In this case, on this spread, that was my first idea. I was using the full size of the contract as the spread, so like an 11-ton contract, so with all the conversion rates in the formula. And I could see that there is some trending going on over the last couple of weeks and months. It was trending down again, and it seems to have like a little change in direction here. So I can in real time use technical analysis down here and see what the market is doing. Once it's in there, as I mentioned before, I can change it to a 5-minute chart, to a 1-minute chart, to 60-minute chart. I can do all my analysis around it. Second try, I did the US copper against the Chinese copper, but not in the full strength of the contract. I used the pricing based on the US side. So that's another way around to do it. Then we have London. This is this one over here. We have the arbitrage between London and bonded copper on INE. Which is also a very, very easy calculation. If you click on the formula box, it's I'm going to show you this one here. It's CP. That's the one I would like to trade now in a second. So it's the US copper minus the LME copper, and there's a conversion rate of the prices. The one is, as I said, in LB in pounds. In US dollars per pounds, and the London is in dollars per metric ton. So I just needed a little bit of a conversion rate. The US contract is, as I said, it's 25,000 pounds. So that's around 11 tons, where the London contract is 5 tons. So I have also on the trading side like a 2-by-1 ratio. So all this on top here is just it's just text. Basically, the formula you need to know is all that little formula. We help you, of course, creating that for you. Once you have it, you created that spread. I can put it on, as I mentioned, I can put it on my ladder. Oh, where it's gone. CP, that's the one. So, and on the trading ladder here on the left-hand side, I get like an immediately best bid and best ask based upon the legs of the outright contracts. So just a quick click here on the legs. I could see the two outright contracts and make sure, yeah, there's liquidity there. The markets are moving, so the markets are live. I'm free to place an order now. On the trading execution, I put already the 2-by-1 ratio in here, and all I have to worry about is really I call it artificial contract, the spread contract. So I can place an order as it would be just a normal outright contract or an exchange traded spread. So I take the ladder, I select the price on which I want to buy at the 0.45. I place an order in the ladder, and now the system with all the defaults in place, you can of course manipulate it and tailor it down more to your exact needs, how you want to do the spread, which legs you want to work, and also kind of what if scenarios if you get hung on an order. But using simple plain defaults, what the system is doing, I'm trying to buy the spread for 0.045 here with a 5 lot. So the system is looking on the more liquid leg by default, again, this can be changed. So it figured out that the CP, the US leg, is a little bit more liquid. It has more volume. So it's looking on the more liquid leg and trying to place an order on the London market based upon what it can execute immediately here on the more liquid market. This is, as a default, but you can very simply manipulate which leg you want to work. If you think you want to work both legs at the same time in order to get like a more speedy fill, that's possible. Can lead to the situation that you get kind of overfilled a little bit. You get like filled on one leg, and then because you're working both orders, and then you don't get the other leg. But that can happen. But it's totally up to you. The other chance, what you can do, you can place the order in what we call the sniper mode, that you actually do not want to show your order on the order book. So you're basically in the background on our servers. You're watching, you're following the market, you're doing your analysis where the prices go, and only if the situation is there, the system would actually fire in the order. So this way you avoid a lot of ticketing and cancel replace orders, and you're not visible basically on the market that you want to do the spread. If I do it in the normal and the default way, you see basically the cancel and replaces for that orders. As we can see at the moment, it's really a bit away from on the London side. It's really a bit away from the market. So probably 2, 3, 4 ticks into the market, probably not a good chance to get that one filled. So what I can do on the artificial ladder, I can just take the price and move it up by 2 ticks, and you can see immediately that my order here on the right-hand side goes closer to the market. The system will notify you if it can happen, of course, just one market moves away, that you get filled on one side, but not on the other side. You get like a notification. You can configure a sound that's coming up telling you, hey, you're hung on the order. And it also changes colors. So if you're in front of the PC, you really cannot miss that there's something going on, and you're exposed to a directional movement on one side and not being filled on the other side. There's various techniques you can put in place once that happens. There's 2 approaches. On the default, with nothing particular said, the idea is if you got hung, you trade yourself out of the market yourself. Depending on the market situation, sometimes you just need to wait a couple of seconds and it all like settles back, and the market's coming back to you and you get the fill on the other leg. It's just a question of a little 10, 15, 20 seconds or 30 seconds of patience. If you feel the market is really running away from you, you could trade your way out of the market immediately. So you could choose to trade the leg that you have been filled on and trade out of that open position as one solution, or you can try to move. Then once that would get filled and it puts an order on the liquid leg that's not getting filled, you can manually just move the order closer to get filled. Then you're not getting exactly the spread price you wanted, but at least you get your legs both filled and complete, and to avoid your vertical risk. So it's a kind of trader choice, saying which way you want to go. If you have presets, if you prefer setting this up beforehand, there's various controls in the CGG. I just want to show it very quickly. I don't want to go in all the details. That would probably take us like another half an hour to go through all the technical things we could do here. But in a nutshell, you can preset how the system should react if you get hung in this kind of order situation. So you can set something up like after 10 seconds, you're willing to pay up 2 ticks on the other leg or on the leaning leg. So you can pre-configure before trade various things here on the platform, here in the if incomplete statement. So you activate the if incomplete, you give your rules what it's supposed to do if the order is incomplete, and then this information goes, I can hit apply or OK here, this information goes to our servers when you submit the order to the spreader servers, and it will be executed. I cannot change it for the working order. So that order I still see it on my local device here in Frankfurt. Of course, it gets all the informations in. I see it, but that order is in fact working between the server very, very close to the exchange and the exchange. So the only way to modify it from the behavior afterwards, I need to pull the order out. I change my settings and put the order back in. Normally, I do that general spreader overview with crude oil, for example. Like you can do calendar spreads on crude oil and other contracts. We tried a couple of months ago. We tried rubber spreads as well. Normally, like my 10 minutes talking usually is enough to get a fill. Not so much today. I really would appreciate if we get a fill report here on our spread. I think to get this filled, I need to move a little bit closer here to the ask side. So now we see the leaning order is kind of between the market and has now we get a fill and has a higher potential to get filled. And exactly as I expected it, I hoped I get a little bit better price, but as I expected it, I will get a clean fill. So it went short 5 contracts here on the London side, and it bought 10 contracts here on the US side. No alarms popping up, no changing in colors, so everything went smooth and clear. I get the information I'm long 5. The spread as designated. Next step I want to do, I want to trade out of the position and just place a limit order on the sell side. And the system starts all over again, placing my orders. This was a very quick run through. I hope I was not speeding too much, but I've been told to stick to like 15 minutes, and I think I kind of made it. I want to hand it over back to Julian. If there's any more questions on the system and how you place your orders on CKG.
Helmut, thank you very much. Very good demonstration there. Thank you. Okay, we're just going to move on now to our final speaker. This is Austin Zhang, who's going to speak about cross-border trading, China's futures and options, the regulatory changes, and the opportunities. Austin.
Thank you, Julian. And thanks, Nanhua, for the invitation. I'm Austin Zhang. I'm a partner based in JunHe Shanghai office. Glad to have the chance to talk about the cross-border trading PRC futures and options, and share some of our observation and outlook on the latest regulatory changes and opportunities. I promise I will speed up to leave some time for the Q&A. And before this presentation, I got some frequently asked questions from Nanhua team. So foreign investors may wish to get a general idea about Chinese financial regulatory landscape. They are also aware of China's latest financial regulatory reform early this year and may have some concern on this issue. So our first topic is about the financial regulatory framework in China. So in this slide, you can see we have different financial regulators in China with different jurisdictions and functions. We have the National Development and the Reform Commission, NDRC, responsible for formulation and the implementation of national macroeconomic management policies. Previously, we have the China Banking and Insurance Regulatory Commission, CBIC, supervision over the banks, insurance company, trust companies. But for the foreign investors that have interest in accessing the PRC futures market, they mainly look at the rules from the China Securities Regulatory Commission, CSRC, which governs the equities, exchange-traded products, bonds, and the futures options with commodities as underlying. Also, the rules from the State Administration of Foreign Exchange, the SAFE, which administrates the foreign exchange control and its inflow and outflow. And in this March, the CBIC actually is merged into National Financial Regulatory Administration, the NFRA. So we will look at the implication of China's financial regulatory revamp in early this year. And we understand that the PRC financial regulators still focus on strengthening the regulation to prevent risk. So like previously, CSRC is just a public institution directly under the State Council, but now CSRC and the NFRA have become government agencies as part of the State Council, which places them in a higher hierarchy, meaning that they will have more supervisory powers and functions. Also, in the past, the PRC financial regulators adopted the method of regulation by institutional type, like CBRC governs the banks and non-banking financial institutions, and the CSRC governs those securities firm, futures brokers, and the fund management companies. So
sorry, Austin.
Yep.
Sorry to break in there. We can only still just see your front page. Is that correct, or are you moving through? Perfect.
Can you see it now?
Now, yes, we can. Thank you very much.
Okay, sorry about it. So we just talk about how the PRC regulators will regulate all the institutions. So there are some like overlapping in the jurisdictions, also leave some space for the regulatory arbitrage. So, but now we have seen the PRC financial regulators gradually switch to a model that to attach equal importance on the regulation by function and the regulation by activities. That means that the PRC financial regulators will look into the substance of the relevant financial activities, that is regulation by look-through, and regulate all kinds of financial activities on an ongoing basis, so as to underscore the need to prevent risk by promoting integrated financial regulation and to eliminate the regulatory arbitrage. Also, some duties of the PBOC and the CSRC of protecting financial customers and investors have been transferred to the NFRA, which is a new national financial regulatory body. We will wait and see how NFRA will exercise its powers and function. So to recap, what we have seen in the China's financial regulatory revamp early this year, the Chinese financial regulatory framework is still evolving in the foreseeable futures, with different emphases on certain aspects in different phases, reflecting a flexible and pragmatic approach. So one of the most important pragmatic approaches is to keep opening up the Chinese financial market. So we will talk about the multiple ways to access the PRC futures market. I think you already know that now foreign investors may have direct access to the PRC futures market through two cross-border channels via the QFII regime and trading the internationalized products. Also, they can set up their local presence like a wholly foreign-owned entity or joint venture in China to trade domestic futures option contracts with their legitimate RMB income. Also, there's always an indirect way that the trading foreign structure products or OTC derivative products that is linked to the onshore underlying assets such as futures and options contracts. So here we have a metric to set out a high-level comparison between three different channels. Now for the QFII models, we have 39 contracts, mainly the commodity futures and the options contracts available to foreign investors. We have 23 contracts available for the international products. Some foreign investors may ask, like, these two channels seems to a little bit competing with each other. But based on our observation, it is the Chinese financial regulators are keen to see that we are now offering different channels to different types of foreign investors. So they are willing to see that there may be a little bit competition between different channels. While for the WFI and the JV model, since it is locally incorporated entities, it should have access to all the available contracts now. For the entry threshold, definitely QFII will have a higher access conditions. Although since the 2019, the update of the QFII regime, the CSRC has relaxed the threshold to apply for the QFII, but now the regulator will still look into the profile and the background of each QFII applicant, will assess their investment track record, their risk control, and the compliance regime to see to evaluate it from a very comprehensive manner to determine whether to grant this QF license. But for the international products and the UFI and the JV model, definitely it has a lower market entry threshold. Also for the QF, it has a kind of stricter disclosure requirements. QF are required to make monthly and annual filing through reporting to the CSRC through its custodian bank. Also, if there's any change to the basic information of the QF or any change to the investment plan of the QF, it needs to further report to the CSRC. For the tax part, I think Alex's presentation has covered this part. We will just skip it. Here we set out an estimated timeline, like for a foreign investor to kick off the project till the day they can start trading. For the QF model, probably it takes 1 to 3 months to obtain the QF license, provided that if all the application documents is submitted to the CSRC, to the satisfactory to the CSRC. But also it may take another 2 to 4 months to open the bank accounts and open the futures account. For the international products model, definitely the timeline, the process may be streamlined. You only need to open an NIA account and the futures account with the futures broker. While for the UFI and the JV model, first you need to set up your local entity and open bank account and futures account. And it may also take some time for the UFI to obtain legitimate RMB income to fund its futures trading. So it may take longer time. But for the JV model, probably the foreign investor can rely on the capital from its onshore partner to fund its futures trading. The timeline may probably can be, to some extent, can be shortened. So, so we can see each of these channels may have pros and cons, and there's kind of no perfect solution. But we have also seen that the update of the QF regime since 2019 is still very exciting and attractive to foreign investors. There are increasing number of QF license holders with different background, hedge funds, prop trading firms, and some of offshore market makers. Recently, some traditional multinational physical trading firms have also been granted the QF license to access the PRC futures market. So therefore, I will spend the last few minutes on the QF regime. So China has this real name account system, which is different from other countries, that prohibits an account holder to lend its futures account to others or borrow others' futures account to engage in any futures trading. Otherwise, the regulator can step in and penalize in accordance with the latest PRC futures and derivatives law, we call it FDL. But some US-based investors may have encountered this US person issue. Actually, we always tell our clients that this is not purely a PRC law issue, because the PRC laws do not explicitly impose any like prohibition or restriction on a US investor trading in the PRC commodity futures market. But in practice, the exchange and the CFMMC impose certain policy restrictions on account opening by a US person investor, meaning because they are concerned that the relevant exchange or the PRC futures broker may be subject to the kind of approval or filing requirement with the competent US regulatory authorities or regulated by the US regulatory authorities when onboarding any US clients. So in practice, we have seen that the exchange will not grant a trading code to US person at the moment, and further require other foreign investors, including those foreign investors trading the international products, to sign an undertaking letter representing that they are not a US person. So we understand that the foreign investor shall first assess whether the circumstances pertaining to a US person specified in this undertaking letter apply to it before it decides whether to issue this undertaking letter. So at this point, so it seems like this letter will become a US law issue, and ultimately the exchange has this discretion to determine whether to grant this a foreign investor a trading code based on the the undertaking letter and the identity information of the beneficial owner disclosed in our foreign investors application documents. But based on our recent experience is that if the foreign investor itself is not a US person and has issued this undertaking letter, in general, the exchange will not look through and trace up to the investors, foreign investors' ultimate beneficial owner to verify whether this UBO is a US person. For the QFII to open a futures account, another commitment letter should be also issued regarding its overseas swap position. So here we set out the specific wording in the commitment letter. The QFII is required to undertake that the trading of commodity futures, commodity options, and the stock index options. Actually, a stock index futures is also included. Through the QFII channel will not involve structured products business and the cross-border derivatives transactions entered into with local securities companies or related hedging transactions. This means that a QFII must cease its overseas structured products business or cross-border derivative business that is linked to the domestic futures and option products, unless it has no plan or will not trade in the domestic futures market directly through its own QFII channel. So although the QFII license holder issued the this commitment letter at the entity level, so we know like for the global asset manager or prop trading firms, they have different fund products or different trading desks. For the products that have already accessed the PRC futures market through this QFII channel, definitely they have to stop their overseas swap trading on the PRC futures contracts. But for other products that have not started QFII trading, arguably they can still keep on their ongoing swap trading, overseas swap trading. But they should, the foreign investor should also evaluate the relevant compliance risk, whether the de facto control account filing would be triggered. So although the current PRC law do not explicitly prohibit or restrict any overseas OTC derivative trading with linked to PRC underlying assets, the legality and the compliance of such arrangement may be still kind of questionable for breach of any look-through regulatory principle under the futures and derivative law. Also, since the underlying assets is onshore domestic futures and option contracts, there may also be breach in the real name account system established under the FDL. Someone may argue that there's no like case precedent or enforcement cases against foreign investor, but we have already seen some case precedent in the securities market. The PRC financial regulators can still look into the substance and determine whether there's any violation and impose the penalty. So we need to bring this to your attention. Also, the PRC financial regulators have the legal basis to penalize foreign investors in accordance with this extraterritorial jurisdiction under the FDL. Also, the QFII rules give the CSRC right to require QFIIs to report its overseas hedging positions related to their domestic futures investment. Next topic, we'll talk about the program trading. So some foreign investors worry about whether the CSRC will impose any further regulation over governing the program trading. We all know that each futures exchange have already put the program trading under its regulation and require filing of the program trading for a while. And now the FDL have this very generic provision and gives the regulator discretion to decide when to issue detailed regulation over the program trading. So we can understand that the PRC regulator actually is taking a very pragmatic method to make it like step by step, not in a rush, because we know the program trading evolves with the technology development. The regulator also want to make sure that the detailed rules, when it come out, it will not be outdated. So probably at the law or statute level, it does not make sense to give a very detailed definition of the program trading. But at the exchange level, the exchange rules will have very broad definition of the program trading to capture all kinds of automated trading or algorithm trading. So also recently, we can see the CSRC consultation paper on the trading server co-location we understand the QFII can also fall into its jurisdiction. So it may take some time for the PS regulator to come out new regulations to see whether more information disclosure requirement or information filing regime will be adopted, and then we will keep monitoring. So probably we will not go into details about this de facto control account filing, which is a very unique system in China, time-wise. But we want to still remind that if a foreign investor fail to make this filing because this filing requirement has already been seen in the relevant exchange rules, also the exchange has very broad criteria for this de facto controlled account filing. But if a foreign investor, for example, of QFII fails to make a filing, now under the FDL, it's a breach of law, which means that the QFII may face administrative penalty rather than the exchange's disciplinary measures. So the foreign investor really need to think about that. So to summarize, we always tell our clients we are always here. We are the eyes and the ears of the foreign investors. We will recommend all the foreign investors to closely monitoring the market developments and assess the regulatory policy changes. We also always encourage them to speak to their external counsels, also some local counterparties like very prestigious futures brokers like Nanhua to find more business opportunities in China. So that's all my presentation today. Thank you.
Thank you very much, Austin. That was very clear. I appreciate that we're now running over time. We've just got a couple of questions. One for you, Austin, is just regarding the QFII taxation issues. I know we touched on this before, but I think one question which has come in is asking that do you have any clarity yet from the authorities as to exactly how they will shape up?
Well, I think this question is still about the tax obligation on the QFII trading the commodity futures and option contracts, right? So if it is the case, currently there's no clear policy, but generally speaking, we believe that the corporate income tax can be exempted, but there will be 10% capital gain tax on the rebate that the QFII will get from the exchange and the broker. Probably, although the policy itself is not very clear, we can still use some adopt some pragmatic method to deal with this tax uncertainty. For example, for the QFIIs, they will open their account with the local custodian bank, and also they can make some like monthly or quarterly filing about its tax payment to the tax bureau where their local custodian bank is located, so that to make sure that the local tax officer is aware of all the tax payment, all the tax obligation that levied on the QFII, so that to make sure that when they make any repatriation, they will be required to issue an undertaking letter that the QFII has already made all the tax payment. So through this method, probably they can mitigate this kind of uncertainty.
Okay, thank you very much. And Li Chensu, just a couple for you. Do you have a time frame on your expansion, on the expansion of your warehousing network for the BC Copper internationally?
Julian, I'm Alex. So I think Mr. Joe Li Chen he left early for another offline a seminar. So yes, so we can probably bring this question back to him later on.
Okay, there's also another question for him, but I'll liaise with you on that. Okay, then I think we are done. Thank you very much. Certainly to all the speakers, it was extremely enlightening, and thank you very much to all the attendees. So I think it's been a very good session.
Yeah, thank you all. Thank you for attending. Thank you for the host.
Great, thank you. Take care.
Thank you. Bye.
Bye-bye.
Yep.
Thank you. Bye-bye.